Well, we have a lot to cover this morning, so let's jump right into it. AJ, Aloja, if you want to look him up that way, has done a great job and a service with apparently no expectations of remuneration of any kind that we know of. At least that's how he reports it. Last night, he posted a detailed, I think it's something like 30-slide look at where he thinks Tesla will end up in units and dollars and profits. And if I might try to put that together for you later today, I have got a jam day, but I might be able to do that. It might not be until tomorrow, but if you want to go take a look at it, you can look over there on X and you'll see it in all its glory. So the bottom line is he sees about 421,000 deliveries. That's the bad news, but the profits will be pretty solid due to improved margins and lower overhead. These are some of his summary thoughts. He says it's important to keep the big picture in mind. Number one, only invest in Tesla at current valuation for the AI products. I think we've been saying that for a while here on this channel. Number two, Tesla is the only company which makes money from EVs and is self-funding. Number three, given its scale, selling 1.8 million vehicles annually, Tesla has exceptionally few vehicles to choose from. The upcoming model segment expansion will supercharge vehicle sales. That's really the important one right there. Well, maybe several are important, actually. Tesla sells the globally best-selling vehicle. This achievement can't be emphasized enough. Number five, energy storage is likely growing 75% year over year in 2024. And he says, I could go on, but this isn't your old legacy company. So energy, new automotive products, AI. Gary Black says it this way this morning. I thought this is one of Gary Black's most thoughtful and given what he's been talking about in the past, it's kind of a little bit of a switch for him. And I talked about this last week, but listen up here. Institutions are changing how they value Tesla. The vast majority look at Tesla how I do. Number one, it's an EV business with, he gives a formula: Tesla fleet times EV take rate times dollars per month, energy, service charging. But most of us see Robotaxi and Optimus becoming big Tesla businesses in the future. And so we want to include the valuations for both. But until we see working prototypes that we can compare to everything else out there so that we can size potential Tesla's market shares and attach unit economics to them, we can't estimate earnings or cash flow with any degree of confidence, and therefore leave them out of Tesla's valuation for now. He says, that said, with the 20 to 24 PE of 75 times, it was 50 to 55 times at the start of 2024, and Tesla's EV business barely growing, the PEG is absurdly high. Clearly, there is a shift in thinking underway about Tesla valuation, with increased weight being put on Robotaxi/Optimus. It will likely come down to, can Tesla continue to grow global EV adoption, still only about 15%, via a $25,000 compact and great advertising until Robotaxi and Optimus prove out and begin to scale. With 72% shareholder support for Elon's comp plan, clearly investors see Elon Musk as the perfect manager to lead Tesla into the AI future. Well, there you go. I think that's right. I think he's hit it right out of the park. Well, this is how Adam Jonas at Morgan Stanley sees it, reported this morning in Tip Rags. Okay, Tesla will still make cars, but we think investors should prepare for something else, the analyst added. We expect MP4 to be underpinned, the master plan 4, to be underpinned by Tesla's commercial ambitions in AI, robotics, hybrid compute, including distributed thermal and compute in the car that spans from cloud to edge. Okay. AI and robotics are entering into an unprecedented phase, unlocking TAMs, total addressable markets, and pushing the company deeper into disciplines. Therefore, Jonas thinks investors should ready themselves for a master plan 4 that will more clearly link Tesla with Musk's other ventures, including SpaceX, Starlink, X, and X.AI. Drawing parallels between Tesla and other tech giants, Jonas suggests the car is to Tesla what video game chips are to NVIDIA and what book sales are to Amazon. The auto business still matters to Tesla, but over the next 6 to 12 months, what have I been saying? We think it may matter less to Tesla's fundamentals and valuation due to a combination of subtraction, weaker EV market, and addition, new product categories, the analyst summed up. Then Gary Black posts this. This is from Bloomberg. So there's the really, really positive statement from Adam Jonas. Tesla price target was cut to 227 from 293 by RBC Capital analyst Tom Narayan, saying he was lowering the estimates for the company's robotaxi venture and it was allocating a bigger revenue share to service providers like Uber and Lyft. Narayan now has a $414 billion valuation for Tesla's self-driving vehicle or robotaxi, down from $627 previously. Tesla has said it would unveil its robotaxi, actually CyberCab, on August 8. The analyst says the two main changes were lowering the price per mile pricing assumption and adjusting the revenue share assumptions. When robotaxi reaches mainstream global usage, which the analyst sees happening closer to 2040, there will likely be multiple software providers, fleet operators, and car makers making these purpose-built vehicles. The taxi app, meanwhile, will likely be dominated by a few players, Narayan adds, and while Tesla will be among them, legacy service providers like Uber and Lyft will also see a strong market position. However, the analyst still sees the robotaxi as the biggest driver for RBC's valuation for Tesla. Narayan maintained his outperform rating on Tesla. Note, Europe's EV. Okay, now this is Randy Kirk. Please hit like. If any of this is helpful, please hit the like button. Please hit the subscribe button. We've got, of course, today, we've got Cern Basher coming up, and I know his is going to be fantastic today. I know some of the stuff we're going to be talking about. It's going to be amazing. And then, of course, we've got Bradford Ferguson coming on for Thursday night's Good News Thursday. So hit notify if you want to be reminded of those. It also helps the channel, by the way, to hit subscribe and notify. So do that if you don't mind. And then join Patreon. That would be a big help. And by the way, a big shout out to longtime Patreon member Beatles for Sale. He sent me a link regarding the glut of copper sitting in Chinese warehouses. At least one person described this glut being so great it simply cannot be consumed, thus the drop in prices recently. Hey, guys, send me your clips. Send me if you see stuff, find me. You can DM me on X. My email is every day down in the description below, so you can email me directly, or you can, of course, join Patreon. And those are the things. If you hit me up on Patreon, you will be seen. Okay, this from the 𝐂𝐤𝐶 letter. Small business outlook uncertainty is surging. So this is just a really big evidence of my concerns. And I'm going to be really looking at the NFIB numbers coming up in the next, it'll be about 2.5 weeks from now. He says that the NFIB uncertainty index increased by 9 points to 85 in May, the highest reading since the 2020 pandemic. Over the last 40 years, such a spike in uncertainty was only seen twice, in 2017 and 2020. Small business owners' business conditions outlook is at the worst in 50 years. According to NFIB, small firms are a major part of the economy, reflecting 44% of U.S. GDP and employing 50% of the American workforce. Global Market Observer, Global MKT, OBSERV, so Global Market Observe. Anyway, Global Market Observe says they also employ 61.7 million Americans, 46.4 share, he says, of the private sector. And from 1995 to 2021, small businesses created 17.3 million net new jobs. From 1995 to 2021, just as we were hitting the problem area, small businesses created 17.3 million net new jobs, or 63% of all jobs created. So, as has been said forever and ever, is that small businesses are the engine of the U.S. economy and continue to be. All right, now this is from the LBM Journal. Mortgage rates that continue hover in the 7% range, along with elevated construction financing costs, continue to put a damper on builder sentiment. Building confidence in the market for newly built single-family homes was 43 in June, down 2 points from May, according to the National Association of Home Builders. This is the lowest reading since December of 2023, 7 months ago. Persistently high mortgage rates are keeping many prospective buyers on the sidelines. The economy and monetary policy more directly is an unusual situation because of a lack of progress on reducing shelter inflation, which is currently running at a 5.4 year-over-year rate, and it's making it difficult for the Federal Reserve to achieve its target inflation rate of 2%. The best way to bring down shelter inflation and push the overall inflation rate down to 2% range is an increase in the nation's housing supply. A more favorable interest rate environment for construction and developing loans would help achieve the aim rather. So therefore, we've got this catch-22. We can't get the interest rates down because of housing inflation, but housing inflation is being caused by a shortage in housing. I guess I've been saying that ever since the channel started, every single month, and I was saying it before I started this channel. The June HMI survey also revealed that 29% of builders cut home prices to bolster sales in June, the highest since January of 2024, and well above the May rate of 25%. However, the average price reduction in June held steady at 6% for the 12th straight month. Meanwhile, the use of sales incentives ticked up to 61% in June from a reading of 59% in May. That metric is its highest share since January. Again, I know I've said this over and over again, but maybe you have missed it when I've said this, is that this is due to I believe it's due to the massive amount, much higher than expected sales over the winter months, which are normally the off-season for housing. So that picked up some of the sales that would be happening now. Derived from a monthly survey the NAHB has been conducting for more than 35 years, the gauge builder perception of current single-family homes and sales expectations for the next 6 months as good, fair, or poor. The survey also asks builders to rate traffic of prospective buyers as high to very high, average, or low to very low. Scores for each component are then used to come up with this number, 50 being average. All right, so then all three HMI component indices posted declines in June and are all below the key threshold of 50 for the first time since December of 23. The HMI index charting current sales conditions in June fell 3 points to 48. The component measures sales expectations for the next 6 months fell 4 points, and the gauge charting traffic of prospective buyers declined 2 points. Looking at the 3-month moving averages, the Northeast was steady at 62, Midwest dropped to 47, and the South decreased 3 points to 46. But the West had a 2-point decline to 41. All right, but now that is their expectation. So that's a survey, but let's take a look at what's happening in general from in true life. We'll look at some housing numbers in just a second, but first, the Labor Department reported, and this is from the Independent, the Labor Department reported Thursday that jobless claims fell by 5,000 to 238 from the 10-month high the week before to 43, and the 4-week average, which evens out to what with the ups and downs, rose by 5,500 to 232. But let's talk about it. It's just average. It's the same. We were not seeing any real significant layoffs. Job security is still good. Nearly 1.83 million people were collecting unemployment benefits, and that's up 15,000 from the week before. Now let's look at some more housing actual data coming in this morning. These are all breaking this morning. Single-family housing starts, which account for the bulk of home building, declined 5.2% to a seasonally adjusted rate of 982,000 last month, under 1 million. That's a really small number. Data for April was revised higher to show single-family starts rising to a rate of 1,036 million units as opposed to the 1,031 reported. But the reality is whatever happened last month, it is now down. This is what I don't even know why they bother to show the last month number. The average rate on the popular 30-year fixed mortgage has continued to pull back after accelerating over 7%. So we're slightly down to 6.95 last week. But that's not enough. It's going to have to be more than that to really, well, first of all, it doesn't really matter. For the house, for builders to start building again, they do need lower interest rates, but they need more than that. Permits for future construction also fell 2.9% to 949,000 units in May. This is, again, a big number being under 1 million. From Market Watch, the Philadelphia Fed, which last month had a great month, and it looked like, well, okay, what's Philly doing right? The gauge for regional business activity inched down to 1.3 from the 4.5% in the prior month. This is the lowest reading since January. Economists polled by the Wall Street Journal expected a 5. Any reading above 0 indicates deteriorating conditions. Key details: the barometer on new orders rose 5.7 points, but remained at a negative 2.2 in June. And the shipments index dropped 6 points to a negative 7.2. The measure on a 6-month business outlook fell 18.6 points to 13.8, showing the manufacturing sector continuing to be in rough shape in Philadelphia. We've already seen slight improvement in New York, but not good. The manufacturing sector is in trouble. The housing sector is in trouble. I'm getting, I don't know. I'm still at 30. I'm still going to be at 35% on my expectation of recession in the third quarter, but I'm really, really close to going all in on that number as these numbers continue to go down. Now, in the meantime, what's happening with markets? Well, the Dow's up 160 and the Nasdaq's down 50. This is a surprising reversal from where we've been seeing it. The S&P down 271. Tesla down $2.93, some more profit taking there. I think it's more money going into NVIDIA. NVIDIA continues to roll because as we look at it here, Apple, Microsoft, the other two of the Magnificent Three, both down also this morning, but NVIDIA up, well, less than it was. It was up a lot. Now it's only up $1.42. But remember, that's $14 pre-split. So we've also got the Cathie Woods mixed this morning. And let's look at the percentages. The Dow down 0.41, NASDAQ, I'm sorry. I'm very sorry. The Dow up 0.41, NASDAQ down 0.21, S&P 0.06 up, and Tesla down 1.58, but still holding over that 180, which has seemed to be a really big number in terms of going, blasting past it above 180, or it ends up being resistance on the way down. Why Tesla is down this morning could be that report from RCP. I'm not sure. But overall, I would say the news ain't great for Tesla right now. And Larry last night was talking about how he thinks Tesla will be kind of soft, could even go down to 150, he said last night, between now and 8.8. Or other people are saying we could see Tesla getting some strength going at 8.8 as the FOMO comes into play. All right, let's go ahead and look at the rest of the numbers this morning. We have got the bonds. We've got the 30-year up 6 basis points. We have got, that could be affecting Tesla. It could be affecting the Cathie Woods. So up 6.2 basis points on the 10-year, the 2-year up 4.2 basis points, and the 2-month actually down this morning, 1.9 basis points. That's a surprising mix. So that gives us almost 50 basis points on the 2 years inversion, and well over 100 basis points on the 2-month, but a slight reduction this morning in both of those. Let's go ahead and look at the oil patch. Oil this morning is up another 70 cents for both Texas Intermediate and Brent, 82.27. So we're just continuing to move up here on the oil patch. We've got the natural gas, however, down a bit this morning, down to 282. It was really starting to look like it's going to go through 3, but down at least this morning. We've got gold, 2-week high, up 1670 at 236, but that's still right in the middle of where it's been over the last few months. Silver up this morning, 2.95%, busting above $30 again, $30.45. Copper up $1.70 at 457. Apparently, they didn't hear the news about the glut sitting in warehouses in China. So, or maybe it's just gone down enough. I'm not sure. All right, we've got the dollar up a bit this morning. We have got the Bitcoin down $70. That's hardly even moving, sitting at 64.7. Again, that's now at the very low end of the range it's been trading in. All right, so yeah, I'm sorry, something amusing popped up in front of my face. I couldn't help but chuckle. All right, so that's where, well, listen, yeah, we got to go back and check Tesla to see if it's continuing to be right about, yeah, it's about flat, going flat along in that $2.50 negative. All right, so once again, please, yesterday had a fantastic session with Scott Walter. You guys were all on vacation. I know you were having a great day off yesterday, out playing and having a good time, not paying attention to anything we were doing over here. All the numbers were low yesterday, but the Scott Walter video in particular is what you should go back and check out. I'll put the card right here. I mean, it was very eye-opening stuff. And then later today, as mentioned, you're going to want to catch Cern. This is going to be one of the best ones ever on Cern. I might do that detailed 30-slide presentation from AJ. You know, I just don't know if I have time. We'll see how things work out. And then tonight it is Bradford Ferguson, and you know his insights are always outstanding. So come join us. Join Patreon if you wouldn't mind. That would be a big help to support the channel. And then I think I'm wrapping it up, and we'll see how the market goes today. What do I think? I think that the market is way beyond its skis. I think the market is going to sell off. I think we're probably going to see zero, close to zero in terms of the GDP in the third quarter. Maybe a surprise in terms of the second quarter being under 1% growth. And at some point, the market is not going to like that. We're going to see a sell-off. But by the end of the year, the market will be higher. And by the end of the year, Tesla will be on a tear. How does that? Is that a nice wrap? It's been great talking to you.